Hello everyone, Tom Simmons coming to you again with another Economics with Tully video, and today we are looking at the revenue streams enjoyed by professional sports organizations, both the teams and the leagues. And what I want to do today is just go over a very general overview as to the different elements of those revenue streams that make up the vast majority of the money that is coming into professional sports. And there's a reason that we divide them into different categories, as you'll see shortly. The general formula that most writers, most economists, most textbooks will suggest that applies to sports is a very specific formula, and I'll give it to you, and then I'll describe each one of those elements, and that is GR plus BR plus SI plus LI equals total revenue. And those are just shorthand abbreviations that we use to differentiate the different types of income that sports teams see. So, GR, the first element, stands for gate receipts. It's the technical term for what you and I might normally call ticket prices, buying a seat. When fans go to a game and they buy a ticket, those are called gate receipts. That's just the technical language of the industry. And once upon a time, that was the main source of revenue for most sports teams. You wanted to sell out your stadium. You wanted to get people to the game. You wanted to make your money by charging people a particular ticket price. Well, that's no longer the main source of revenue for most sports teams, which is ironic because you would think that, gee, this is all about getting people out to your game and to fill your stadium, and it really isn't insofar as the largest amounts of money coming into the team. The second element, BR, stands for broadcasting rights. And this actually has become one, if not the, biggest sources of income for most professional sports teams. And we're going to come back and look at broadcasting rights in a little more depth. Because this element has a very long and strange history with professional sports. But suffice it to say that right now, most sports teams and most leagues get the majority of their revenue from selling rights to cable companies or radio stations or television stations to air their games. The third element, SI, stands for stadium income. And these are all the little extra things that people spend money on when they go to a game. The parking fee, the concession stands. It could also be the amount of money that an advertiser pays to have their advertising logo plastered on the scoreboard or somewhere around the stadium. It could be special events that the stadium holds. It could be preseason games or postseason games that are not part of the regular season, special exhibition games that are not part of the regular season. And it's also things like special corporate boxes. Because when a corporation buys a corporate box suite, that's not considered a seat ticket or a ticket price. That's considered stadium revenue. And it's very important to draw the distinction between the fan buying a ticket for a seat and a corporation buying a suite that may involve catering and seats and all sorts of nice amenities, because the first are gate receipts, the second are stadium revenues, and they're handled differently within the team. A special dining facility, a special VIP members only facility. All of those kind of things are stadium revenues. And stadium revenues have become another enormous source of revenue for sports teams. Not necessarily the leagues, though, and we'll see why shortly. The last element, LI, refers to licensing. And some teams or leagues may sell things directly from their stores with their logo on it. But if a clothing company, such as Authentic Athletic, wishes to make hats and use New York Red Bull logos on them, they have to pay a licensing fee. And so this becomes another source of income for sports teams and leagues, and probably everyone watching this video has got a cap or a jersey or something that has a team or a league name on it. And unless that's an illegal knockoff, which happens a lot, that means that company that made that had to pay a licensing fee to the sports industry in order to use that particular logo. Those are the four main divisions that we use to describe the revenue coming into a sports team or league. So let me go back a little bit and spend a little more time talking about broadcasting rights, because as I said, it has such an interesting history within this industry. When television first came out, most baseball owners were afraid of it. They didn't want TV around. They didn't want the game being shown on TV. They pushed against TV for quite a long time. And the reason was that at the time they got most of their money from gate receipts, from tickets. And they figured it was okay to allow radio to broadcast the games because you couldn't see the games. But when television came out, the big fear was that people were going to stop coming to games because they're just going to watch these things on TV. Why should they have to get out of their house and come and pay a ticket and maybe sit in chilly weather or drizzly weather when they could just sit at home in the comfort of their living room and watch the game on this box? And they were really afraid of TV. Now fast forward many decades, and we see the entire opposite has happened. TV has now become the bread and butter of professional sports. And here's why. Keep in mind that it's not as if sports teams have to pay television to broadcast them, like an advertiser does. It's the opposite. Media companies need to pay the sports teams for broadcast rights, because the TV stations know that one way to get a guaranteed demographic, guaranteed viewership, is by saying we are the home TV station of the New York Yankees or the Boston Red Sox or the San Francisco 49ers or whoever it might be. Now, why would they pay? Why would those media companies pay? Because it gets viewers, it increases their numbers, and then they, in turn, can go to advertisers and say, look, we are broadcasting all of the Cubs games. We are broadcasting all of the Philadelphia Eagles games. So, if you want a guaranteed audience, and usually that audience is seen as younger and middle-aged men, if you want to reach a guaranteed demographic with your Budweiser commercial, pay us. So, TV and the media companies have an incentive to try and become the broadcast station for the sports teams. And they're willing to pay the sports teams for the right to be the exclusive broadcaster of their games. Then they can turn around to advertisers and say, pony up the dollars if you want to broadcast on a night when we know we're going to have a lot of watchers because the World Series is on, or it's Monday Night Football, or it's the Stanley Cup playoffs or something like that. So sports learned that they could make a lot of money, or at least make a lot of revenue, by bringing media revenues in. And this is one of several reasons why most sports teams in most leagues are located in big cities. New York, Chicago, Boston, Dallas. Because there's big media markets, many viewers, lots of money, and advertisers will pay a heavy amount to get their advertisements broadcast during those games, so those sports teams can charge the TV companies higher amounts for broadcast rights. Now, in the last maybe 2 decades, there has been a very strong movement towards something called revenue sharing. And this is something I'm going to go into in much greater detail on a league-by-league basis as we go further into this course. And revenue sharing basically means that some revenue, some proportion of the revenue that a sports team brings in has to be shared with the league. And that's done for 2 reasons. First of all, it supports the league offices. There's got to be a way that the commissioner of baseball gets paid and that Major League Baseball's home offices gets paid for. And some of that will come from this revenue sharing. But it's also because the revenue is brought in, is shared with the league, and then the league turns around and distributes that back to teams that are having a harder time raising cash in order to create better balance between the teams in a league. Now, each league, baseball, football, basketball, hockey, soccer, each of them has their own formula to decide and to figure out how much of your revenue has to be shared with the league and then redistributed. And each league not only has their own formula to say how much has to be shared, they also divide the revenues up the way I've described them into gate receipts, broadcasting rights, stadium income, and licensing, because some revenue they will require that the team shares, and other revenues they will not. For instance, most of the time, stadium revenues stay right home with the home stadium. And that gives those stadiums an incentive to make more money through special restaurant clubs and corporate box seats and advertising at the home team level, because that money stays 100% at home with that team. The owner of that team has an incentive to maximize income coming from those sources. On the other hand, very often broadcast rights, especially national broadcast rights, are required to be sent to the league, or a portion of them are required to be sent to the league. So first, when we look at baseball, because they have the longest history, they started out not liking TV at all because they thought it would take away from ticket sales. That was not the case. Then they fell in love with TV because they realized they could charge high prices for broadcast rights and take in high revenues. Then they got stuck in the place of the league saying, well, we want you to share a certain percentage of your broadcast revenue, kind of like a tax on broadcast revenue. So then the teams got very creative in deciding, how can we continue to leverage this money coming from TV without having to share big parts of it. And that brings us to really what is the heart of what I want you to get from the readings in this lesson, and that is these related party transactions. And let me give you a very, very simple way of how this works. Let's suppose I own 2 companies. All This is one company, and this is the other company. As a general rule, I want to make a profit. And as a general rule, it does not matter to me whether I make $100 from this company and nothing from this company, I just break even, or if I reverse it, make $100 from this company and I just break even with this company, or I make 50 from this company and 50 from this company. In all three scenarios, I own two companies and I've made $100, so I should be happy either way. Now, what happens if, let's say the government comes and says, well, we want to tax this company right here, but we're not going to tax this one here. Well, now it makes a difference as to which of your two companies makes that money. Because if the company being taxed makes the money, you've got to send some of that to the government. Whereas if the company that is not taxed makes the money, you don't have to send anything. You get to keep everything. And so this is the model that many teams, particularly in baseball, and they really pioneered this, have begun to use ever since revenue sharing began to require that they share broadcast revenues. So, for instance, you will have one owner, and actually this is a very specific case. You have one owner who owns, let's say, the Boston Red Sox and the New England Sports Network, NESN. One is a baseball team. One is a media company. I'm the owner of both. So one way I can make sure I don't get hit with this league tax on broadcast revenue is to make sure that my media company, NESN, makes a lot of money and that my sports team makes a little less money. So the way I do this is maybe in a normal world, in a totally free market, the Red Sox would have the right to charge $50 million to a media company for the right for that media company to broadcast Red Sox games. But since I own both the media company and the sports team, instead, the Red Sox only charge NESN $10 million to broadcast all their games. So, what effect does that have? Well, it means the Red Sox are getting in a lot less money than they could be, which lowers a great deal the overall revenue that they say they make, or they say they take in. And it's a lot less that they have to pay a tax on to the league. Instead of the Red Sox making that money, the cable company makes that money, NESN. NESN is not a sports team, it's a media company. Therefore, it cannot be taxed by Major League Baseball. It doesn't have to share any of its profit with the league. So, what happens is, and what has happened over the last 10 or 20 years, is that many sports teams have worked out an arrangement whereby they have begun creating their own media companies, or their owners will purchase one of their media companies. And the numbers I just used there were not real, so don't think those are the real numbers, but actually those numbers are very real when it comes to the Tribune Company, which owns WGN, the largest media station in Chicago, and the Chicago Cubs. Tribune Corp owns both. And that is exactly what they did. I think the year was 2001. The Cubs only charged WGN $23 million for broadcast rights that were actually worth $55 million. At the end of the year, The Cubs told the world, oh, we actually lost money this year. Baseball's a really hard sport. Why would they do that? Well, it helps them negotiate money from the city if they want to rebuild or improve a stadium. It enables them to go to their players and say, hey, we don't have any money to give you extra. It makes it look like they're not making money. In fact, what they did was they gave a gift of over $30 million to the media company who is making all the money, and the owners, doesn't matter to them whether it's coming from the team or the media company. All they know is if the money comes from the media company, they keep it all. If it comes from the sports team, then they've got to share it around to other teams. So, what has now become the biggest source of income for sports teams then became the very thing that the leagues wanted to tax in order to spread around and help out smaller teams and less profitable teams, and now has generated a whole new industry whereby teams are working together with media companies, or owning their own media companies, or being owned by media companies, or having one owner own them and the media company, in order to transfer wealth out of the team and into the media, and thus avoid having to share any of their income. In the reading that I've provided two readings for you in this lesson. One is a history of this rocky relationship in the past between baseball and TV. The second is a short history on 5 or 6 different baseball teams currently, and how they had set up these related party transactions to make their income look less than it is and avoid paying the revenue sharing tax to the leagues. So take your time. They're long readings. They're a little heavy going through, but it will be well worth your understanding of what's going on to take your time reading through these and understanding how these arrangements are set up. Okay, that is my short video for this lesson, and get to reading. All right.